Buongiorno a tutti, I am Paolo Sironi, your host of The Banker's Bookshelf. The Banker's Bookshelf is a podcast show in which I invite authors and researchers of the most interesting books and publications about the banking present and its fintech future. And in this episode, I invited Jason Mikula for a conversation inspired by his new book, Banking as a Service. Jason, welcome to the show.
Pleasure to be here, and I suppose the title couldn't be more literal.
Jason, many people know you, but let me just say a few words about you for those that are new to your work. Jason is the founder of the FinTech Business Weekly, a newsletter that provides in-depth analysis of trends and business models in banking and fintech. He is also advisor and investor in a series of fintech. And he has hands-on fintech experience as a former product manager of Marcus. Marcus is the digital consumer lending app of Goldman Sachs. So Jason lived directly multiple aspects of the banking transformation with technology. And this is also revealed by his book that provides a comprehensive look at the banking as a service world, strategies and architectures, equipping us with an understanding of the origins, the evolution, the future, and the applications of BaaS. Also looking at the differences across global markets. There's a lot of examples in his book which are really worth reading. But before we get into the details, I want to ask Jason an elevator pitch. Why should you read his book? What makes it different from other books on the topic?
Yeah, absolutely. So, I think the last several years, we've really seen the idea of banking as a service sort of explode in popularity, both as far as fintech builders that are using this model to develop businesses and customer-facing products and services, interest from banks in pursuing these kinds of business models as far as being able to maintain relevance, gather deposits, originate loans, generate fee income. And of course, interest from regulators, as we have seen not only in the United States, where I focus a lot of my time on, but in Europe as well. Some challenges in the model, particularly as it relates to financial crime risk and other sort of regulatory and compliance controls. And so it does sort of feel like we're moving into, maybe I guess depending on how you divide up the eras, the third or perhaps fourth wave of banking as a service, which, and I think we're going to get into this, but it's sort of perhaps the opposite side of the coin to embedded finance, another very popular term, and sort of understanding how did we get to where we are now and what might the future hold are really the topics I try to tackle in this book.
Okay, so basically you explain the origins and its evolution because it's a business framework which is evolving over time together with the understanding of how to make it happen and make money with this and together with the technology because technology is also changing. So you mentioned embedded finance. We talked about banking as a service, which is the title of the book. Can you help the audience understand in your words the difference between open banking, embedded finance, and banking as a service?
Yeah, absolutely. So, one of the ways I think about it is that banking as a service is the how. How are you achieving this? And embedded finance is the what. What are you trying to achieve, right? So it helps to illustrate that with a concrete example. One of the areas where embedded finance has really developed a lot of interest is in non-financial companies, brands, adding some type of financial capability to their product. So imagine you are a non-financial company, whether that's something like a shoe company like Adidas or Nike, or everyone likes to use the Starbucks example, so I'm not going to go there. If you want to offer your customer base a regulated financial product, in most jurisdictions, it is difficult or perhaps impossible to do that on your own, meaning that you need to partner with a regulated or chartered financial institution in order to do that. while it's certainly possible for these non-financial companies to directly partner with a bank or in jurisdictions where e-money licenses or other types of chartered institutions exist, partner with those institutions. The idea of banking as a service is kind of a technology intermediary that simplifies that partnership, right? So if I'm Nike or Adidas, and for whatever reason, I want to add some kind of, uh, you know, savings account or regulated financial feature to my product, I can do that by leveraging a banking as a service provider. And some of the language around this, is also different in different jurisdictions. People might talk about partner banks, but for the purposes of this discussion, we'll use BaaS or banking as a service in order to embed those financial capabilities within my product or service. Open banking, in my mind, is a bit distinct, and unfortunately, this is also complicated by the capabilities being, quite different by jurisdiction. Fundamentally, I think of open banking as about data portability, which is definitely true in the American context. People will also refer to that as 1033 in reference to the specific part of Dodd-Frank, which calls for this consumer data right. But it is worth pointing out that in other jurisdictions, including the EU, where both you and I are at the moment, there's actually the capability to do payment initiation, which people often bundle in with that idea of open banking. So you can have an app that is leveraging this open banking framework to cause a consumer's underlying bank account to move money. And as far as how open banking in the United States has developed to date, that capability does not exist and does not seem to be on the horizon in the near term in that market. So it does make it challenging to have these conversations, particularly in sort of a global context, because in each individual market, these terms might actually mean sometimes significantly different things.
Okay, so let me summarize it a moment with my words. Say that open banking, the last one you mentioned, is more a framework for data portability. It's not necessarily a business model. It can be regulatory driven or can be part of a practice in a certain market. Embedded finance is basically on the strategy side where you connect business to businesses, like a banking business to other businesses, and they want basically to expand their portfolio or their connection with customers and clients. So they need to define how to make money on both sides. And the banking as a service is the how of all of this. If you don't have that, if you haven't created it, you cannot do it. And so these players in the BaaS world facilitate the connectivity between the financial services world, other financial services institutions, or non-banking in a way that is done, hopefully, with security, compliance, and gracious comfort. Now, why would banks do that? In a recent research of the IBM Institute for Business Value, thinking in terms of embedded finance, so the old strategy on top of that, we saw that 24% of the banks worldwide define embedded finance as core to their strategy. Now, you want to know if they are talking the talk or walking the walk. Having said that, embedded finance is a large portfolio of strategies and potential business models behind that. 20% said that they're live one way or another with an embedded finance piece. So that means that they're leveraging a technology component to connect with a simple API or even to orchestrate a bigger platform. The two are very different. So which are the main drivers for you, for banks, to do this? So to look at banking as a service in terms of expanding their portfolio or, if you like, interacting with other players that might want to engage with them, having technology at the core of the engagement model?
Yeah, absolutely. So, again, there are going to be some differences by geography, but I think a common theme is about distribution, right? The days of walking into a bank branch to open an account, deposit money, withdraw money are largely behind us. And the majority of financial institutions, at least historically speaking, are not particularly good at developing technology, right? That hasn't historically been a core competency of banking. Risk management, balance sheet management, hopefully compliance, these should be and are core competencies. Building and deploying technology, really hasn't been. Certainly there are counter examples. JP Morgan Chase spends literally billions of dollars a year. You referenced my time at Goldman. Ultimately, as a business unit, that was not successful. But they did build and deploy that a fairly polished app and user experience. But by and large, this is not something banks are good at. And so if you are not acquiring customers and acquiring deposits because I'm walking past the ABN AMRO branch in Utrecht, or you're walking past, the Deutsche Bank branch in Frankfurt, how are you going to acquire these customers? Historically, that might have been, well, let's say more recent historically, that might have been because I go to the bank's website or find the bank's app, right? But increasingly, the strategy is to shift to meet particularly consumers at their point of need rather than waiting for that consumer to go actively choose to go to that bank's website or that bank's app. I think the buy now, pay later companies do a really good job of illustrating this, right? So I guess let's go back to my shoe example. If I'm buying a new pair of shoes and they're very expensive because I'm training for a marathon, you know, on the one hand, I could actively choose to open a new tab on my browser and see, can I get a personal loan or a credit card from my bank? But if at the point of time when I'm trying to make that purchase, I see Klarna, I see Affirm, I see some other buy now, pay later financing, that solution embedded into that purchase flow is there exactly when I need that to solve the problem that I'm trying to solve, buying something.
So is this an opportunity for the large banks or the small banks?
It should be an opportunity for both. I will say that in the American market, the call it maybe top 10, top 20, if you're being generous, banks already have such a stranglehold might be overstating, but just such an extremely large presence that they don't necessarily need that distribution, at least in the consumer space. There are some maybe behind the scenes capabilities, particularly in like payment processing. Some folks might dispute whether or not that's truly BaaS. There are opportunities for the very, very large banks to play in this space. I think, again, particularly in the American market, which there's all sorts of bizarre history there that we don't have time to get into today. But in a market that has something like a total of between 9 and 10,000 chartered banks and credit unions, really all but the very largest institutions are frankly fighting for their life. Now, that might not be today, tomorrow, this year, next year, but as far as being able to maintain the deposit base they have, grow the deposit base they have, and continue acquiring high quality assets, aka either originating loans themselves or buying loans in the secondary market, buying securities, distribution is key to that. Going back to the sort of technology challenge, if you are a small bank in Arkansas or Tennessee, you don't have the billions of dollars JP Morgan Chase does to spend on technology. Building branches to the extent that there are some banks that still do that is not a particularly high ROI activity as far as generating new deposits, new customers, cost of customer acquisition. Digital distribution, which allows you to operate in the United States, nationwide, should be far, far more efficient. And so to try to circle back and make sure I answer your question, I don't necessarily think it is a big bank versus small bank thing. However, I do think that there is perhaps more of a imperative for smaller banks to pursue these BaaS and embedded finance strategies, basically as a lifeline to maintain and hopefully grow their businesses.
Okay, so let's say that if I represent well your thinking here, the large banks might have the technology means, but maybe less appetite because they're dominating markets. The smaller banks might be lighter in terms of technology, or they feel they are not so autonomous, so they don't have big budgets, but they could have an appetite to grow and to distribute it differently. And that's where I guess the banking as a service intermediaries can play a big role because they can facilitate basically the connection between the needs and the opportunity. When I researched on these topics 2 years ago, 1 year and a half, I asked 700 bankers worldwide that were working in open banking, embedded finance, or partnership banking, which were the key KPIs that they had identified to explain to the CEOs and the management the progress of their initiatives. And there were a set of options, but then one day the majority picked up as the major KPI was revenue, generating more revenues. The second is having more clients, if you like. And at the bottom, instead of this list, we found things like support, okay, to the partner in open banking or embedded finance. And instead, when we spoke to the non-banking, so the players that are on the other side of the fence that need to consume banking services in their journeys, what they said is that they don't have enough support. Like in a sense that things can go off. They need to have support with the customer. So they need to have visibility, for example, in part of core banking. In essence, it's like saying that banks are good at buying technology. They're not necessarily good at selling technology because shaping that framework and that agreement is of a different kind. So we need to think differently. So now, what are the business models or the frameworks that you believe are emerging or already got established that basically help players to leverage banking as a service, as a business model in a way that they understand how to drive their joint success?
You raise some very interesting points. Particularly the idea in banking as a service and embedded finance, where this sort of relationship is almost inverted, right? In the sense that a bank may be acting essentially as a service provider to this third party company that is actually the customer facing entity, right? So to give an example, if we're talking about the neobanking space, which again is challenging to talk about this because in the EU, most neobanks are probably EMI licensed or actually hold a full bank charter. In the United States, the majority of them actually have no specific type of license or charter, right? So if we use, for example, Chime, which is probably the most popular US neobank, Chime is not a chartered or licensed entity, right? It works with two banks on the back end. One is called the Bank Corp, which has been in, I guess, the partner banking space or BaaS space for a very long time. I mean, since at least the late 1990s. They also work with a bank called Stride. If a customer has an issue, they don't know those banks exist for the most part. What they know is I have Chime as an app on my phone. My paycheck goes to Chime. My card says Chime. If they have a problem, they're going to be mad at Chime. But the reality is the legal and regulatory obligations and also sort of the support necessary to address that customer's challenge if they have one is probably some combination of these bank partners, Chime, and perhaps another technology intermediary like an issuer processor. And so for banks, again, particularly smaller banks that may have less, maybe newer entrants to the BaaS space, the idea that actually you need to have not only the right systems and technology in place, but also the right personnel to be able to serve what is ultimately a client, maybe a very different way of approaching and operating business than they're used to.
So, what is the most common business model to you? How do the intermediaries define the opportunity?
So I am going to sound like I'm beating a dead horse here. Definitely varies by jurisdiction, right? So in United States, for banks with less than 10 billion in assets, interchange, so the amount that's generated when somebody swipes a debit card, is not specifically regulated. It tends to be about 1.5%. Which for listeners in the EU probably sounds crazy because debit interchange in much of the EU is capped at 20 bips or 0.2%. And if I understand correctly, here in the Netherlands where I live, interchange on Maestro is a flat 2 cents, which to American listeners probably sounds insane. But a lot of what we saw when interest in banking as a service in fintech was really exploding, particularly as things got very frothy in like 2021, 2022, was around these interchange driven business models, more so on the fintech customer facing side. The bank in those kind of programs also shares in that interchange, but generates revenue from program fees from working with these fintech clients. I think on the bank side, the two most prevalent models or drivers. One, as a source of gathering deposits, right? So as we came out of the pandemic and economies around the world began to struggle with inflation, what did central banks do? Raise interest rates. As central banks rose interest rates, what happened? Banks' cost of funds increase. If you're a gigantic bank like JP Morgan Chase, I actually have still a checking account at Chase. Guess how much it pays in interest? Well, the checking account pays 0. I have a savings account there. What does it pay? I think like 2 basis points. So functionally 0. But not every bank has the luxury of being a behemoth like JPMC. For everyone else that actually has to pay to gather and hold deposits, cost of funds rose very dramatically. BaaS and fintech partnerships, if you look at the banks that engage in those business models, typically their cost of funds rose less quickly and peaked at a lower level than banks that were not engaged in those business models. So that's one example. The second distinct example would be what I think I call in the book origination to distribute of loans. So again, in Germany and the Netherlands, countries that are not big users of consumer credit, so like this example wouldn't really apply. In the United States, if you want to lend money, you can either go and get a license in every single state that you want to lend money in, or you're a bank and you use your charter. So if you are not a bank, but you want to lend money in every state without getting a license and having a slightly different product, you do it by partnering with a bank, which I would argue falls under this BaaS umbrella. There are a smaller number of banks that have really focused on that business model historically. WebBank, which is out in Utah, Celtic, Cross River, and a handful of others. And the idea there, the pejorative language would be rent a charter, but basically that the customer facing company partners with this underlying bank to originate a loan. And then the bank, once that loan has been originated using its charter, sells usually at 95% of the value, the economic value of that loan. That can be very lucrative for the banks because it's fundamentally a capital light strategy. You're generating fee income by originating the loan, but because you're then selling on the risk, you don't have to hold loan loss reserves and capital against it. So if you look at like ROE, return on equity, for banks that engage in that business model, historically they've had sort of disproportionately high ROE compared to sort of what a median bank in their cohort would have.
Okay, so what you're saying is that there could be different ways of monetizing on banking as a service, clearly interchange fees or loan origination. It is never the same because, of course, it depends on the jurisdiction the players operate in. The regulation is different, the consumer habits are different, so you need to basically understand how to fit in certain market characteristics. Now, although banking as a service provides opportunities and some of the players have effectively outperformed their peers in terms of return on equity, being more capable of accessing customers for a lower cost or having a model that is more flexible when market conditions change, is not gold or that glitters. So can you give me two quick examples? One that is a positive example, and one that is a troubled example where the players got trapped into a situation that required a regulatory action.
Yeah, absolutely. So again, I'm going to lean on the United States just because I've spent so much more
We have a
time.
big audience there and a lot of curiosity about the US. So
Yeah. So, for a number of reasons, that some of which we've talked through, these models have appealed to smaller banks. I think historically, a way that regulators have thought about relative riskiness of banks is in relation to the asset size of those banks, which from like a systemic risk perspective makes sense, right? If you have you know, 100 million asset bank fail, that's not going to be a systemic risk. Whereas, I guess 2 years ago now, when SVB failed, SVB was, I think at the time, at least a top 20 bank, maybe like 12th largest, like that posed a potentially systemic risk to the banking system. I think the flip side is a lot of these small banks, and one that I wrote about recently, CBW, which is 70 million asset, tiny, tiny, tiny bank in Kansas, 30-person staff, has gotten in trouble with its regulator, the FDIC, related to BSA and AML compliance. And when you look at, and this is all public in the consent order and other documents that have come out, they were processing billions and billions of dollars in wire transactions, including for high risk jurisdictions like Cyprus and Lebanon. And the bank staff was 30 people. So it's a question of, are banks that are operating these business models investing in the systems, the technology, and the staff with the necessary expertise to adequately monitor, mitigate the risks in those business lines. And unfortunately, there are ample examples, and not just in the U.S. market, but Railsr, or I think it was a Railsr subsidiary in the EU, ran into issues. There are a handful of others where sometimes folks see what appears to be a potentially lucrative business line and don't necessarily think about the costs necessary to operate it in a way that is going to keep them out of trouble.
Which I guess also opens up for the opportunity or the possibility to leverage compliance capabilities as a service. And not everything can be built by a small entity that makes the banking as a service type of activity an ecosystem-oriented activity. You need to make sure that you focus on what is really important and most likely being capable yourself to partner with others to prop it up in a way that makes sense.
I do want to make sure that I sort of point out the counter example, which is that I do think there remains a lot of opportunity for BaaS business models, both to be supportive of access and inclusion, right? So like the flip side of banks de-risking, particularly when it comes to things like AML risk, is that marginalized populations may find it more difficult to have access to the formal financial system. And I do think there's an opportunity if the customer-facing company, customer-facing fintech, and the underlying bank partner do make the necessary investments in staff, in systems to run these programs in a compliant way, I do think there's an opportunity to better serve customer segments that perhaps historically have not been well served by the traditional banking system, including certain segments of SMB in the U.S., certain segments of higher risk businesses like cannabis businesses, or consumer segments that may lack traditional forms of documentation, so undocumented immigrants, for example. And then on the bank side, we have talked about why some smaller banks want to engage in these business models as far as fee revenue and deposit growth.
Jason, that's a very good point. In the recent research on small and medium enterprise banking, we saw that the cost to serve SMEs is typically very high for banks, which creates a funding gap for these players. And these players are relevant because SMEs are 90% of the firms worldwide. They have 70% of worldwide employees, and they contribute to 50% of GDP, which in some countries is even larger and much higher than that. So everything that can be done to better serve these cohorts of clients is beneficial for everyone because it improves the world economy. And some of the elements here which have to be considered are all of these are very varied individuals, especially solo entrepreneurs or small businesses that are not formalized in the way they contribute to the economy. So banks have a harder time in understanding them, which forces them to pile up a lot of cost and manuality. So how can technology help them, or how can they reach out to them on a non-banking ecosystem where there is a better way of understanding their market, their presence, and therefore their credit risk in a way that the cost is reduced to serve them, and some of these benefits are passed to the banking client as well in terms of lower lending rates without compromising risk management. Now, if you look before we conclude a few years ahead, what do you believe would be the most interesting evolution of banking as a service? Can be in a specific region. Understand that not all jurisdictions are at the same level of maturity, or they are taking the same path in terms of transformation. But what do you think would be the most relevant characteristic?
So, as far as geographically speaking, I do think, and frankly, this is true of fintech broadly, not only banking as a service. I do tend to think that emerging markets where either historically they've been less competitive, highly consolidated. So we've absolutely seen that, for example, in Brazil with the rise of Nubank, or where, for a variety of reasons, large segments of the population have been unbanked. So, listeners may know I spend a fair amount of time in Mexico. Something like 50% of Mexican households remain unbanked. There are certainly a lot of reasons for that, but I do think banking as a service specifically and fintech broadly have a lot more greenfield opportunity in countries where banking has either been less competitive because it's highly consolidated, and or where there are segments of the population that historically have been outside of the formal financial system. So that could be large swaths of Central and South America, Africa, Southeast Asia. I'm not going to pretend to be an expert on all of these regions because I'm not, but I do think that the needs there are different and in a sense sort of larger or more pronounced compared to a market like the UK, Netherlands, the United States, which comparatively speaking are very well served by financial services. If you look at the United States, something like 96% of households are banked, and of the 4% that are not, half actually do not want a bank account, right? And so as far as if you're starting sort of a new business, even if you're aiming at the underserved segment of the market, chances are you're trying to win that customer over from another company. Whereas Mexico, Brazil, India, Vietnam, the dynamics are very different and may lend themselves more to rapid growth at lower costs.
So I think that consumer banking is highly commoditized, not everywhere in the world, but largely speaking, clients tend to be served in a very thorough way. But SME banking is where there's much to do, and everywhere in the US as well as in Africa. So I believe that there is a lot of space there for banking as a service to basically make the difference for those that want to leverage the technology and the capabilities in terms of creating new ways of reaching out to clients and create more value. Now, Jason, your books are on Amazon. So
Yes.
I invite everyone to take a look at them. Any specific place where you want the people to follow you on LinkedIn, on Twitter? What do you use?
I'm unfortunately still on Twitter, so you can find me there at Mikula JA or LinkedIn. Best place is probably Substack, which you can find at fintechbusinessweekly.com.
Okay, I invite everyone to subscribe to the fintechweekly.com as well. And I remind all, I think that Jason's Banking as a Service is an excellent book. I personally found it easy. Thanks, Jason, for writing it. Is plenty of real life examples that piqued my brain, and they are in every continent, so you can see what happens and basically compare and contrast. And I think it is a very good Banker's Bookshelf recommendation, so go there, buy it, and read it. If you want to understand how banks and fintech interact on banking as a services, is a must read book. Now, I invite everyone to stay tuned for more conversations with banking and fintech authors and researchers. Don't forget to subscribe to the Banker's Bookshelf. We stream on your preferred platforms such as Spotify, Apple Podcast, YouTube Video, YouTube Music, Amazon Music, so you can find us everywhere. Thank you for having been with us today, and don't miss the next episode. Arrivederci a tutti. Enjoy the closing jingle.